Welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for our market insights and observations. Today is Thursday, January 19th of 2023. And let's get down to the three topics moving markets. We're paying attention to it at Blanke Schein Wealth Management, as you should be too. So thanks for watching. So our three topics today, the Fed speak, and that's essentially capturing the headlines this week. Federal Reserve Chairman Jerome Powell, as well as all the Fed, essentially just committee members and presidents, and I'll show you the list of speakers this week, are out in full force talking about sort of the hawkish posture that the Federal Reserve will remain completely committed to maintaining. They get ahead of and on top of and ultimately run the course of inflation. But I'm going to show you some of the headwinds that the Federal Reserve is up against, essentially coming down to the U.S. labor market. This morning we got a report that the labor market's still tight right now. And then we're also going to go through the recession checklist, as I alluded to earlier this week on Tuesday. But today's economic data comes in mixed, and yes, we still have several Fed speakers ahead of us to rattle markets. And here's the rest of the week. We have Vice President Brainerd and a couple other committee members tomorrow and Friday, so the week's not over yet. Keep in mind we have option expirations, not only this week, at the end of this week, but in the several upcoming weeks as well, which is going to increase the market volatility that we're seeing in the markets already. But yesterday, Fed's hacker threw some cold water on some things. Basically, it will come sometime before the Fed lowers interest rates, and the data will determine the path, which is not exactly news breaking, if you will, or news shattering. It's just the market has had quite a good run year to date to start the new year. And in fact, the NASDAQ up until yesterday was up 8 sessions in a row, which is significant. So we've seen a bounce to start the new year. But right now, the bears are leading the charge right now. And then the Federal Reserve is adding to that. Now, Jamie Dimon, the CEO of JP Morgan, when Jamie speaks, market listens, so that's why we put this here. He also believes that the Fed's going to go well above the 5%, meaning for the Fed's funds rate, they're at 4.5 right now, for 4.25, 4.5, and he believes that they're going to have to basically use that to get rid of the underlying inflation, and it won't go away quickly. So that's the story, the theme for 2023. And our base case here is that the Fed will stay sufficiently restrictive for this year due to the tightening in the U.S. labor market. Now, this morning, the U.S. labor market only had 190,000 claims. Now, what does that actually mean or look like? Here's the total U.S. claims right now, and it's still going in this direction, meaning the U.S. market for job demand, again, keep in mind there are 10 million job openings for 6 million people who are looking. And that number seems to be going down at this moment. So that's the gap that we're going to discuss and talk about that the Federal Reserve is looking at. Now here's what we're talking about, the JOLTS report. I've talked about this several times, is what the Federal Reserve looks at, and it's basically the jobs opening report. Now we've seen at least some improvement to the downside, and the U.S. unemployment rate is still down here. Again, at 5.7, just under 6 million, as I just pointed out. But this is the gap. We need this to go up. At least the Federal Reserve is looking for that to go up, while this goes down. And this gap right here is essentially the key to watch for the normalization of ultimately inflation and wage inflation, because that's the stickiest of the inflationary pressures within the market. And that's what the Federal Reserve's squarely keeping an eye on. Now, here's our recession checklist and what we're watching as financial conditions ease, if they do or not. But they use it. So let's just go down the indicators. And there's some key things that are happening right now. Housing, the checklist, it's declining, as we've seen before. The University of Michigan Consumer Sentiment Report, yes, it's down by 10 percentage points. That's down. The ISM, new factory orders, that's below 50. If it's an indication above 50 or above, that means that the economy is expanding. If it's below 50 in this number, that means the economy is contracting. So that's going in the right. That's trending in the right direction for the Federal Reserve, but it's also then on a recessionary dashboard. We've talked about the 210 spread for the yield curve, and essentially that's just meaning that the 2-year yield curve or the 2-year Treasury is higher yielding at 4+% than the 3.4 on the 10-year. So it essentially should be looking like this. It's like this, so it's called the yield curve inversion, and it's a leading indicator of what we are seeing as a potential recession in the U.S. Now, so as I was discussing the recessionary checklist, we have 8 on this dashboard right now that we're paying attention to regarding the monitoring the U.S. financial conditions and watching if they continue to deteriorate. But 4 of them are flashing red on this dashboard. Now, what's the most important right now? Well, we know that the financial conditions are going to continue to tighten. It's the Federal Reserve. We've already had the indication earlier, as I discussed, what JP Morgan was talking about, or what the Fed speak was talking about earlier. So we know that this will be happening, but this is the one right here. It's the credit spread. So it's the BAA spreads, which is below investment grade. It's increased a little bit. Now, if this thing keeps going, which means that junk or high yield or stress within the economy, companies that honestly don't have the best balance sheet have a lower credit rating. It's no different than you and I with a credit score. This is just the way they rate corporations and their credit worthiness, if you will. They get a grade assignment just like you and I get a grade assignment with a credit score. So this would be in the case of around the below 600 range of a credit score, if you will, if you translate that into U.S. Sort of consumer credit. And as you know, as there's stress in the economy, there's stress on corporations that have a difficulty with they don't have the ideal balance sheet or the strong balance sheet. So this right here is going to be the number one thing that we're going to pay attention to in terms of the U.S. continuing to go into recession. And we will see this increase. We will see the credit spreads increase between essentially separating the high quality balance sheets, which we own for our clients, versus low quality. We don't we don't spend any time in low quality either fixed income or low quality companies for our clients. High quality is slow and steady and wins the race over time. We like strong companies, strong balance sheets, really well run, great brands, and that gets us through not only bad times, but also good times as well. And those companies also do extremely well. The stronger companies do extremely well because the not so strong companies, the weaker companies, during recession, most likely, oftentimes either get consolidated and taken over or just washed up and close up shop. So that makes the large, strong companies even stronger on the other side of the recession. And that's sort of the key of the game here. But that's what we're keeping an eye on. That's a recessionary checklist right now, and overall the Fed speak and how we see the market. So thanks for watching our market insights and observations for today. We'll catch you again next time. Take care.